appreciate everyone joining on our monthly investor call. It's a great chance for us to tell you what's going on in Trophy Point over the last few months, and then also a chance to provide some more color on what's going on in the market, especially the real estate single-family home market that we specialize in at Trophy Point. And so I'm excited about our guest, Ray Northcutt. He's an investor and also a heavy hitter when it comes to the conventional side of the house in real estate, which is really important for us as private lenders, because the private lending and the conventional side of lending in our space, they coexist, because one really can't exist without the other. So we'll get more into that as well. Let's go ahead and jump right in. So a little bit about me. I am a private lender. I also own a lot of real estate, and I feel like you can't be a really good private lender if you're not an owner of real estate, because the decision-making on owning real estate and lending on it are largely the same. And that central question is can I get paid back on the loans or the money that I put out? And so I've done millions of dollars of deals, hundreds of millions of dollars of deals at this point. I'm a former Army officer as well, with deployments to Iraq and Afghanistan. And my favorite thing to do actually is teach. I teach real estate entrepreneurship at Georgia State University. And I find that experience actually teaches me more, or I get more out of it than my own students do, actually. And so I love teaching. I love sharing insights, learning insights. And Trophy Point is almost like my canvas to do that, in addition to my teaching duties. So Trophy Point's had an excellent record so far. We've closed 16 quarters, almost 16 quarters as of at the end of June, in a few days, without a single loss on any of the loans that we've done. And we've lent out about $140 million so far, and we've actually been paid back on $80 million as well. So, like I say, any idiot can send money out the door. It's getting paid back that is the true test of a capital allocator or a private lender. We've done 700 plus loans, and so we've built a name for ourselves inside our niche, inside the private lending space. We've got 125 distinct borrowers, but 700 loans, which means that, in our case, 60% of our borrowers are repeat, meaning they keep coming back for more loans, and that's actually what we really care about from a lender perspective. But like I said, I love teaching, and I also love helping, because I don't like to lose money. I hate to see other people lose money. Real estate's one of those games where you really can't afford to lose. And so you may have heard this adage where if you lose 50% of your money, it takes you 100% of what's remaining to gain it back. And it's very tough to gain 100% of your money in real estate in a short period of time. And so it's much better in our game that we don't lose money at all. And so I put my phone number up there. That's my direct line. Feel free to call me if you've ever got a real estate deal or a real estate question. Whether you invest or not, or whether you do any business with Trophy Point, it doesn't matter. I love helping folks. In this particular case, Mike Martin was a fellow West Point grad, who was thinking about buying a multifamily asset. And he came at me with some questions regarding the repairs that the previous seller or the seller had represented to him. And I told Mike, why don't you just, and Mike was suspect of those repairs. And I said, Mike, why don't you go to the permit office and pull those permits, or see if those permits were ever applied for. Mike did that, and it turned out the seller had never pulled the permits. And furthermore, it turned out that the work was not even done to code. So had Mike taken over this property, he would have been faced with a bill to bring all those multifamily units back up to code, which would have cost him probably hundreds of thousands of dollars that he did not plan on. That would have killed all the perceived profit in the deal, which in this case, he says you would have been paying on that mistake for a long time. And so I'm happy with a 10-minute phone call with me. We were able to save him a lot of money on that deal. And I take great pride in being that kind of guy that helps people not lose money. So call me. So if you don't know what private lending is, we're also known as hard money lenders. Borrowers can go to a bank or to a private lender for their commercial/investment grade deals. We don't do any permanent residences. We don't do primary residences or owner occupied residences. That's actually what Ray does. But in our case, people are borrowing money from us because the banks take too long, the banks may not give great terms, or the banks have crazy processes, paperwork requirement processes that have nothing to do with the deal. And we kind of cut all that out, and we do it in a more streamlined fashion. And we close loans, up to $1 million within 2 weeks. And there's a need for that. There's a need for for fast capital and no nonsense lenders like ourselves, which is why borrowers pay us a higher rate of interest. And we take that high rate of interest that borrowers pay us, and we pass the majority of that on to the investors in our fund. And Trophy Point has about $60 million and 170 investors in our fund. So we're kind of sizable. And then on top of that, me as a principal, I have $5 million of my own money in the fund as well. And I take the first loss on any bad decision or bad loan that we make because I believe in what we're doing. All those things in combination have helped us become one of the top private lenders in the country over the last couple of years. So here's a brief overview of our monthly update. So last month we sent out about $490,000 to our investors' accounts. We've got about 60 million under management, 173 investors. There's a QR code on the slide there if you want to access our latest investor materials. We are audited. In fact, we're just about to finish our audit. I just saw the draft today, so I'm happy to report that our audit is almost done. And we publish our numbers monthly, actually, so that investor portal has our balance sheets and things like that. And then you can see the interest rates that we offer investors. And so we offer an 8 to 12% coupon bond-like return backed against the assets of the loans or the funds that the collateral that we make. And so far things have been pretty good. And I also like to point this out for context. I don't think you can find as good of an investment as private lending these days. The stock market has returned 8 to 12% historically, but there's a lot of volatility or ups and downs in that return. So for example, in 2022, the stock market lost 20% of its money, whereas Trophy Point paid the same rate to our investors. And in fact, if you take the annualized return of the stock market with dividends reinvested, Trophy Point actually beats the market over the last 3 years on an annualized basis. And we do that in a safer manner without the volatility, and we're always secured because we always have a lien on the properties that we lend on. So private lending, the category of private lending or private credit as we call it, deserves a spot in your portfolio. If you haven't thought about it as an investor, I think you really should. And again, here's what we offer. It takes $25,000 to get involved, which offers an 8% coupon. We also have the ability to reinvest your dollars. So it's a really strong compounding vehicle as well, which is fantastic for younger folks, especially. We do lock up your money for 18 months, which is pretty good, actually. Most funds have 5-year lockups. And if you ever want your money back, just give us 90 days notice after the initial lockup period. And like I said, between me and my partners, me alone I have 5 million, but between me and my partners, we have 6 million in a first loss position, which is fantastic because we really put our money where our mouth is. We share the risk in a greater fashion than the investor does, actually. We also, have better rates for retirement accounts or self-directed retirement accounts. So believe it or not, you can take your stocks in Fidelity or your Roth IRA that's housed by Fidelity, and you can actually transfer that to a custodian or a trustee, and then they can make actually self-directed IRA investments on your behalf. And Trophy Point is approved as an IRA investment for self-directed IRA investment with many custodians. Actually, we have about $8 million of retirement dollars from investors, and it's all gross tax-free, of course. So let's get on to the main event. Actually, I wanted to talk more about the market because that's really what we're here for. Like I said earlier in the beginning of this presentation, the private lending market matters a great deal to the public lending markets or to the conventional lending markets, and vice versa, because our borrowers that buy an investment grade property, that fix it up, add value, and then attempt to sell it, the buyers of our borrowers need conventional lending, people like Ray, to provide loans to buy out the collateral, to buy out the loan that essentially we have made as well. So it's a very symbiotic environment, and we pay close attention to the liquidity, to how lenders are lending, and to what's going on in the market in general, because that's what supports this ecosystem in our case. Like, our loans are 6 to 12 months, and so they move very fast. And so all that fast or that velocity is predicated on public lenders like Ray getting involved in what we do. So I'm very happy to present Ray. Ray is actually an investor in Trophy Point, and it's very gratifying to know that someone that's a professional, that's been in the business for a long time, that's very smart, has given us the trust and confidence to invest his money, his hard-earned money. As you may know, most mortgage officers, loan officers work on commission. And so, It's hard-earned money. I believe every dollar is equal, but I definitely believe also that not all dollars are earned equally. And so I have a sweet spot for folks that earn on commission because it's very tough. But Ray is also a West Point grad, so I'm happy to report that as well. And he's been in the mortgage industry for at least 5 years, and he's one of the top VA lenders in the country. He's with UMortgage, and Ray. With that being said, I'm going to unmute you and give you a chance to chime in. Please tell us your story. Would love to hear more about how you got into this business, why you got into this business, and we can go into the market data from there.
Yeah, absolutely. Can you hear me, Samir?
Yeah, go ahead. Yep.
All right, cool. Thank you for having me. It's an honor to be here. Welcome, everyone. It's great to be here and to give you my perspective of things. I'm a huge believer in Trophy Point. Like Samir said, I'm invested in. I did a lot of homework on where to invest. And this, I've been in real estate for, in one capacity or another, not that long, since 2016. And I've done a lot of different things, which we'll get into a little bit. But Trophy Point, it's kind of the answer for me. And so I thank you, Samir, and your partners for setting this up and giving us an opportunity to invest in it. A little bit about myself. Currently, I'm a mortgage lender at UMortgage. I do specialize in VA loans. We'll get into a little bit more VA specific stuff in a few minutes towards the end of this presentation. But a little bit of background about myself. From Atlanta, Georgia. I went to West Point, graduated from there in 2013. Go Frogs. And branched engineer's first duty station was Fort Knox, 19th Engineer Battalion, 18 months straight of PL time, and then took an assignment with the Corps of Engineers in Savannah. And Savannah, Georgia is where I got bit by the real estate bug. While working with the Corps, I had time to listen to podcasts and read books and kind of get involved with what is this real estate investing thing. And there was this empty, vacant house next to the house that me and a roommate we were renting. And this vacant house had a toilet sitting on the top floor deck. And it was vacant house, been vacant for a long time. And we were like, wouldn't that be cool if we bought this? This is me and my fiance at the time. We were like, oh, we should buy that place and turn it into a rental and have a full rental empire, just dreaming. And that's what got it started, was that stupid toilet. And and lo and behold, now I've shaped my post-army career around lending and around real estate in a few different ways. First of which was buying a house with my own VA loan. It was a single family home with a carriage house there in Savannah. Carriage house is the Savannah term for an ADU or a mother-in-law suite. And I had that roommate. Roommate moved in with me. She brought a friend. Then I had the carriage house, so I put a friend in there. Next thing you know, I was doing the house hacking thing. Or a house hack, if you guys aren't familiar with the term, is living in a home, renting out other space in the home, whether it be bedrooms or other units, to supplement your mortgage. So I did that for the first time there in Savannah, and at the end of each month, I was cash flow positive, $600 after all the bills are paid. I was like, holy cow, this real estate thing really works. Like it actually is working. And so after that first purchase, I went out and bought a bunch of little single family homes. Well, not a bunch, it was 5. Some of them needed work, some of them were turnkey, but I learned property management, I learned cash flow analysis, learned how to screen tenants and how to estimate rehab costs, and did a lot of the work myself through sweat equity, and learned a lot, developed different cash flow streams of income, and with these little single family homes, couple duplexes around Savannah, and it was working really well. A year after buying that very first one with the VA loan, I sold it and then bought a quadplex also in Savannah. Moved into one unit, rented out the other 3, used a lot of really aggressive rental strategies for those other 3 units. We did room by room rentals. We did student rentals, shorter term stuff, not short term, but kind of mid length, like 6 to 9 months. Utilities included, furnished, stuff like that, room by room. And by the time I ETS'd, newly married, and rented out all 4 once we moved out of that 4th unit, and had that thing cash flowing north of 3,500 a month, just one house. And that's what kind of paid all the bills. After ETS, my wife and I, we traveled. Our honeymoon was actually traveling around the country, living in a camper for like 7 months, looking for where we wanted to live because she hated the heat and the humidity of Savannah, Georgia, right? So we just set sail, living off of rental income, and it was amazing. I was a full believer in all things real estate. And of course, keep in mind this was, bought the first house in 2017. So this is 2017, 2018. Things were on fire. You couldn't lose. The only way to lose was to not play the game. So things were great. And so we eventually, 7 months on the road, doing a lot of skiing and snowboarding, just living the dream. We wound up in Idaho. That's where we call home now. This little tiny town called McCall, Idaho, 3,500 people, and that's where we planted our stake in the ground and lived there for a couple years. And we bought a house off of just rental income. And I'll tell you what, that was a great learning experience as well, buying a house just off of rental income. And the first three lenders I talked to had no idea. This is before I was a lender, and they had no clue how to do it. And I was like, you know what? I mean, I think my numbers are right. Like, I think this should pencil and I should be able to get pre-approved and actually buy this house, this little cabin just off of rental income. But like, I wasn't a lender. I didn't know all the rules, but like, I was pretty sure it would work. And sure enough, called a West Point guy. The fourth lender I called was a West Point dude. I think he was a 92 grad, and he got it done. And I learned so much just before even becoming a lender. I learned a lot from that process, and all the homes prior, just analyzing cash flow and monthly expenses and learning what the cost of money is and how that kind of plays into investing in real estate. So living in McCall, where I was like, well, I gotta do something with my time. I can't just be retired. So at 27 years old or whatever I was, so I became a realtor. I got my real estate license in Idaho. Like about 3 months after getting my real estate license, I had hung my license at a local brokerage. I'm like, all right, let's build a book of business in this little tiny 3,500 person town. And about that time, we were looking to buy our next place there in McCall, and I called up another West Point lender for a loan. And Pat and Gade, I don't know if you, I'm sure some of you have heard his name once or twice, but that was 2020 May, and I called him up for a loan. Conversation somehow went from loan application to job interview, and the rest is history. Like that evening, over the course of that day, I called a few mentors, and by that evening, I had said, this real estate agent thing is for the birds. Let's go be a lender. The rest is history. I'm still with Pat and Gade. He is still my branch manager. We've been at 3 different lending institutions together over the course of the last 4 years, and it's been amazing. He's taught me a lot about the industry and got me involved. And it's a very gratifying thing to be able to help veterans all across the country with their VA home loan needs and to get them into this business. That's a little bit about where I come from and how I got involved with lending. And so from there, we can talk a little bit about the market and some different trends that we've seen over the past few years. And we'll start here with median sale price. So this chart goes back to mid 2012, and you can see that the general trend, trending up. And you see these little peaks and valleys. So the peaks are your selling seasons. When real estate's hot, spring and summer, things are selling for more. And then the valleys, things are selling for less, staying on market longer. And then you look over to COVID, right? 2020 to 2021. Very beginning 2022. That's where you see the craziness kind of start, where we had rates that were 2.25%, 2.75%, 3%, 3.25% for investment properties, right? Just craziness. Everybody is going nuts, buying everything and driving the price up with bidding wars, things going way over listing price. And so that's where you see kind of the chaos there in 2021 and things really spiking up and not really even coming down like it normally does in the slow season. And then towards the right, present day, kind of normalized, getting back to like the average trend left to right. And right now we're in June 2024, and it's a peak, and it kind of looks right in line with where things were headed pre-COVID. Yeah, median sale price 440 as of May last month, and things are selling. I mean, yeah, they're more expensive, but they're right in line with kind of where things were going.
Yeah, one thing I'll point out, I think one of the reasons why it's been growing, the median sale price is growing, is that the lack of housing. So depending on who you read, we're close to 3 to 5 million housing units short in this country. That did not exist, in 2008 when we were overbuilt, really. And we've added 30 more million Americans basically since 2008. And we haven't been building at the rate we should have been, just at the replacement levels to begin with. And on top of that, the average age of a home in America right now is between 35 and 40 years old. So every year, housing stock continues to age. It's not being replaced. And we need more houses, obviously, because there's more and more people. And on top of that, a lot of new neighborhoods, a lot of communities don't want new developments in their backyard. It's called not in my backyard, or NIMBYism. So all those factors combined have led to a severe housing shortage, and it's been driving up the cost significantly for a home, which actually, as a lender, it's fine. It's okay by me. It's not as great for the consumer, to be honest, but for a lender, it's great because it means that our collateral value will always be stable enough that, because we only lend at 70%, most lenders lend at 80%. Trophy Point lends at 70% loan to value, with there's a lot of safety, but it means that we're always going to have great collateral underlying what we loan on. And that's how we, mitigate against losses primarily.
All right, so this chart is median days on market. So again, the peaks and the valleys. So this one's interesting as well. See the peaks longer, things are staying on the market longer during the cold months. Like during winter, real estate is slower, people don't want to move. So the peaks are your slower seasons. And then the valleys are the spring and summer, when things are on the market for fewer days, they're selling quicker. As you move from left to right along this graph, you see the crazy effect once again, 2020, 2021, when we were at the lowest rates in the history of mortgages. Things were just flying off the shelves and staying on the market for 20 days, give or take. But as rates climbed in 2022, you see that steep climb there, like basically spring of 2022 all the way to 2023, right there. I mean, that's where people were shocked. They got accustomed to their 2.5% mortgages. And I can't tell you how many calls I fielded with people just livid that they had to take a 4% on their mortgage. It's like, well, I mean, you look at the last 20, 30, 40, 50 years, 4% is pretty darn good, still pretty low. But eventually people got over that shock. And here we are, May, June of 2024, and we are pretty much back to normal with this trend pre-COVID. You just had the COVID, the 2020, 2021 crazy low rates. Now we're right back in line. So average days on market 32. That's not bad. Like, things are selling. I would not consider the current market an extreme buyer's market or an extreme seller's market. I would honestly consider it pretty balanced, and 32 days on market is pretty solid. In my opinion, even though prices are high, and yeah, the average median price of a home is $440,000, people are still buying them. There's a lot of equity in the marketplace. People are qualified, and they are out there buying homes.
We actually got an anonymous question. What number of median days on market do you think would have to occur for you to get concerned? Like, if you started seeing days on market go beyond what number, where you think something is really up here, or something's going on?
I mean, I think if like the norm, like an average priced home for like a starter home, call it 300,000 to 400,000, I guess. If that was sitting on the market for a couple months, I mean, that would probably show that, okay, everything is getting stale. For some reason, there's fear in the marketplace and nobody is buying homes. and maybe we start making much more conservative, risk averse decisions. What's your take on that, Samir?
Yeah, I feel like it's definitely market dependent, and you can find data by market. So I think like Austin, Texas, which we're gonna get into later. I think if you sold a home within 60 days in Austin, Texas, that's actually pretty good.
Yeah,
But for most metro cities, I would start to get concerned as a lender, kind of nationally, holistically, if I start to see, median days on market go past 60 to 80 to 90.
yeah,
Um, that tells me we've got, a big slowdown coming, or it's already here when it comes to these houses. I think, the other thing you may have touched on, well, you did touch on it, but indirectly, our world depends a lot on velocity and trading of properties. That's the number one determinant of value and like the health of a market. Not so much the rates, because rates can be relative due to inflation and other factors. Not so much like the median house price necessarily. It's just about our houses trading, and we would get scared when we see houses not trading at all or taking a very long time to trade.
sure, sure. People just sitting on properties, not getting their money out into the economy, and
Yeah,
not investing in anything, not making any moves, burying
yeah.
their money in a jar in the backyard.
So we also got two more questions. One's about the difference between Trophy Point and the Academy Fund. I'll actually get to that question later once Ray finishes his portion. There are some differences, actually, key differences. Then Marissa has a question on, are there any VA programs for investment loans, or is it truly just the one product we all know about of a typical zero down VA loan?
Yeah, so yeah, I mean, I'll jump a little bit more into VA in a little bit later, but I'll answer this one for sure. So the VA loan is intended to provide housing, safe, sanitary, and sound housing for service members. And it is not an investment vehicle. It's not intended to be an investment vehicle. All right. So there always is a occupancy requirement tied to the VA loan, meaning you need to intend on occupying that house within 60 days. If you never intend on occupying the house and you buy it with a VA loan, then that is mortgage fraud. Technically, that is mortgage fraud, and I would never recommend anyone ever do that. But say you buy a house with a VA loan and you move into it, and 6 months later, after you've lived there for 6 months or so, you get married and you need a bigger home, or you have a child and you need a room, you need a house with an extra bedroom. You can move, and then you can keep that house and turn it into a rental. You don't have to refinance. You don't have to sell. Just turn it into a rental and move. And you can use the VA loan again. And we'll talk about that a little bit more later too. But that house can become an investment property, but it cannot be bought as an investment property, if that makes sense. The other way that I would consider a quasi, investment, whatever, is if you buy a multifamily home with a VA loan. You can buy a home with up to 4 units with a VA loan. And you're not going to occupy 4 units, you're going to occupy 1 unit. But if there are other units, if it's a duplex, a triplex, or a quadplex, you can rent out those other units besides the one you're occupying. So in a way, it's an investment property, right? Because you're renting out those other units, but you are still considering that a primary residence because you're living in one of the units. I hope that kind of answers your question there.
Yeah, and also to add to that, the as a variation of what you just said, house hacking also applies. If you're going to occupy one room and you rent out, two or three of the other rooms and have roommates, that's also permissible under the VA because you're still going to be the primary occupant of the
Yeah,
property.
absolutely. At the end of the day, you have to live in the house. But what you do with the other space in the house, rent out the other rooms. I mean, I personally, I think that is the best way to get started in investing in real estate is a house hack with the VA loan. And to supercharge that, if it's a quadplex and you're renting out the other units and living in one, I mean, 0% down on a quadplex. Come on. And maybe buy a quadplex that's a little bit dated, that's still safe, sanitary, and sound. Like it meets all the requirements. A VA appraiser isn't going to flip his lid when he walks through it because it's a doozy. It doesn't need a ton of work, but it's dated. You can add value while you live there through bringing it up to speed with some light cosmetic renovation. I mean, you add all that together, and that is such a great kickstart to investing in real estate, if you ask me. Okay, average list to sale percentage. So what this chart is showing is what does a house end up selling at compared to what it was listed at. So 100% means it sells at exactly what it was listed at. So historically, I mean, you can see historically 98% is pretty normal. Anywhere from 97 to 98, 96 to 98, that's pretty average. And here's the effect of the crazy low interest rates during the COVID era. You have everything, literally everything selling above asking price. Some things going 20, 30, 40, $100,000 over asking price. I mean, it was absolute chaos. Every single property on the market, I'm sure you guys remember how chaotic it was and how every property was a bidding war, and it was just an extreme seller's market. But post COVID era, rates started to climb in 2022, and things like just returned to a general normal state over here towards the right side of your screen. Right now, nowadays, 99.9. So things are moving, things are hot. Like you do see some properties with multiple offers, and some things are going above asking, but by and large, things are pretty much selling pretty close to what they're listed at in a lot of markets. And there's another slide coming up where we see some different markets where you can kind of see where some are probably selling a little bit lower than list, some are probably a little higher than list, but this is a national average where things are pretty much selling right at list.
When would you start to get concerned? Like at what level or threshold do you believe that, if you start seeing 96 cents on the dollar, 95 cents on the dollar, 90 cents on the dollar, what's your perspective on that?
That's a good question. So I started learning about real estate in 2016. So, when things really tanked in 2007, 2008, I was playing baseball and chasing girls in high school. So I think you might have a little bit better perspective, honestly, on that. And I mean, do you remember back then kind of what the signs in the market were?
Yeah. So incidentally, I bought my first hotel in 2007 as a cadet, actually at West Point, and then 2008 hit, and I didn't make any money for 5 years on my commercial property, but I noticed that homes, and I also, believe it or not, I also flipped 20 houses between 2009 and 2012. So I was kind of more exposed or more in the game kind of during and right after the crisis. And it's also market dependent, but I was noticing homes that were listing and selling for close to like 80, 90 cents of list price, actually. It's the people that are selling homes in a crisis. It's also like if they're trying to like get a job or they lost their job or something like that, where it really starts to go up. And so, but let me put it just this way. It's market dependent. It's also very situational dependent. But during 2008, 2009, homes were selling for about 80 to 90 cents of list price. Now, that's a big difference between the folks that were foreclosed on. And there's a huge difference there. And the foreclosures, those are being liquidated at 60, 70 cents of the market value of the home at that time. And it was pretty much done because the banks themselves were under distress and they had to sell homes quickly in order to right size their balance sheets. And so I point that out because there's a distinction between a consumer driven transaction versus like a bank or commercial driven transaction where there's an investment fund or a bank that sells the home. This really ought to be split in two, but it's very hard to kind of find that data of who the consumer owners are and who the bank owners are, or who like the investment fund owners are. And when I start to see the commercial owners, like the banks and the funds, start to sell at 90, 85 cents on the dollar, that's when I know something's up and it's going to predicate probably a downturn maybe in the future. Because they're the ones that are typically smarter and more sophisticated, and they typically get out first before the rest of the market follows.
That's interesting. That's great insight, Samir. Thank you.
Yeah. I kind of learned that actually because I actually, when I was 23, after my hotel, the second company I bought was a debt collection business. And I was collecting debt on behalf of HOAs in Seattle. And so I got in tune to how like HOAs collect debt. And believe it or not, in that state, in Washington State, HOA debt trumps even mortgage debt. And so we were foreclosing on behalf of HOAs that were hurting for dollars, basically. HOA stands for homeowner associations, for those that don't know. And they charge dues or fees to homeowners in that neighborhood to maintain the quality of the neighborhood. I learned a great deal of like how that all stuff works. And, there were plenty of investment grade homes owned by banks due to foreclosure. And those guys were the first ones to get rid of properties. And I was able to use that sort of experience to buy homes very cheaply. I was buying homes for 70 grand and selling them for 220 a year later during that period.
That's outstanding. Love that. Love that. All right. So this graph here, this is since 2022, when we were talking about how rates started to go up rapidly. What has been the effect on home prices since that point? So from 2022, like spring-ish 2022 until now, blue means the prices have increased, and red means the prices have decreased since 2022. So it's just kind of an interesting depiction of kind of the, on a national scale. You see the East, obviously things are still going up. Besides, even though rates have gone up, prices are still kind of generally going up as well. And then you have some of these coastal markets, Boise, San Francisco, Austin, New Orleans, Florida. Florida always has its own thing going on, right? But kind of overhyped markets, and kind of feeling the effects of the rate increases, with things slowing down a lot more rapidly in some of those markets. So I just thought this chart was interesting. What are your thoughts here?
We love this chart actually, because we're Trophy Point lends in 22 states. Ray, I think you're licensed in all 50 states, and we care a lot about markets. And so we've actually stopped lending in Austin, Texas, for example, because the supply and the exuberance in Texas were good leading up to 2022, 2023. But mid 2023 onward, we actually stopped lending there, and we're kind of glad we did, because it's just tough. And so,
because I mean, on a short term, like you're borrowing money for 6 to 12 months and doing a flip, and during those 6 to 12 months, you don't want the value to steadily be decreasing on a home that you're looking to sell and profit on. So 6 to 12 months, you're working on a house, you're paying holding costs, you're paying for money, you're paying for rehab, you're paying all this stuff. But in the background, you want the home and the property itself to be appreciating. I mean, you're not going to appreciate a ton in 6 to 12 months, but you don't want the thing to go down in value. So not lending in some of these markets as a short-term lender is very prudent.
Yeah, I mean, we say internally, like we say we want to lend into appreciating markets, meaning like we want to lend with the tide, not so much against the tide, unless
right.
a borrower comes to a deal with like a stupid discount, like 40, 50% discount comparable to the comparables or the market around it.
And one last thing on this slide. So Boise, that's where I currently live, Boise. And look at it. It's like the darkest red on here with Austin and New Orleans. But you know what? I know a lot of dudes flipping homes here that make as much money as they want to make. I mean, so there are deals here, and I'm a believer that there are deals in any market. You just have to go back to your fundamentals of investing, know your numbers, do your due diligence, and don't overpay, and you can find deals. But it's when you start speculating and overpaying is when you get yourself in trouble.
Yeah, I like that a lot. That's correct.
All right.
I'll also point out that close to 60 to 70% of the American population lives east of the Mississippi River, and and the blue areas are primarily where we lend. We actually don't lend in California, many of the Midwest states. We don't lend in Nevada, Idaho, Montana, things like that. But we like to lend in population dense areas, because it kind of goes back to my earlier point about from a lending commercial activity standpoint, you want to lend where there's velocity. And that's also predicated or based on the fact that there's people living there, right? And when there's more people, there's more velocity, there's more trades happening, and you get a better sense of price and value when those things happen.
For sure. And you got a pretty big migration of people coming out of California and moving east. So
yeah,
you just got a lot of population growth and migration happening, and people moving out of New York City and Chicago and stuff, and into some of these other metro areas in the East. And I don't know, there's just a lot going on. So I agree with you.
Yeah, in Atlanta, where I live, we have about 100 to 200 people moving here a day, actually.
Wow. Yeah, so this one's interesting too. I mean, it's a very similar type of data set here. The 10 markets that have gone up the most since 2022, and 10 markets that have gone down the most. So you'll see a lot of those same cities on the right, the red ones on the right, Austin, Texas, leading the charge, and Boise, ironically enough, number 4. And then you know, on the left you have a lot of these ones on the left are let's see, are there any that are in the West? New Jersey, Connecticut, Georgia, Illinois, New
Oh,
York, Jersey. Nope, they're all in the East.
yeah.
And let's see on the right, we got Texas, Louisiana, Idaho, California, Utah, again, Florida doing its own thing, and Arizona. So, I mean, there's a trend for sure. But I'll just reiterate the point. If you want to flip homes, you have to stick to the basics. You have to know your numbers, know your renovation costs, know your holding costs, know the cost of your money, know what your timeline is. I mean, get these things as dialed in as you can. Know your ARV, your after repair value, and know what your profit margin needs to be, and build yourself in a little wiggle room. And because stuff happens. I mean, you start fixing up a house that's 80 years old. I mean, you're going to find stuff, and you're going to run into unforeseen costs and expenses. So just build that in with a safety net, and just do your own due diligence. Don't trust. I mean, if you've never worked with a wholesaler and they bring you a deal and says it only needs $20,000 worth of work, and then you can sell it for $180,000 more than you buy it for, just run your own numbers and get a contractor that you trust, and do your own due diligence. Get your own comps and do your own research, and make sure it's a solid deal, and don't overpay. You can work backwards, calculate your maximum purchase price, and don't overpay. Don't be emotionally involved in the deal. It's business. So if it doesn't work, it doesn't work. Move on to the next one. And if you stick to that, then I'm a believer that it doesn't matter where you're buying. I mean, granted, also part of your due diligence is looking at rental markets and demand for rentals. So if it checks the boxes, it checks the boxes. Like I said, there are plenty of people that I know personally here in Boise, in one of, this on the right side, 4th worst market, right? But there are plenty of people flipping homes making lots and lots of money here. So take it with a grain of salt, and do your homework is my advice. A little bit about VA and what I do on the lending side of things. So I work with a lender called UMortgage. UMortgage is a smaller lender, but we are the fastest growing lender in the country. So we're growing like a weed, and we have a heavy focus on VA. So 34% of our total loan volume is VA, and that's much more than most lenders out there. And the vast majority of that 34% is the branch that I'm on. There's 12 of us, and the UMortgage Veterans Alliance is our branch. And all of us are prior military in one form or another, different branches of the military, but we all served in some capacity, and we all have a heavy focus on VA. And we service we're not 50 states, we're actually 48. We don't have New York and Massachusetts yet. More to follow on that, but pretty much, unless you're in one of those states, we can help you wherever you go, whether you're in the Army and PCSing, or whether you're out and you're moving around after retirement, we can help you. All right, a little more about VA loans, some common myths and misunderstandings. All right, so I'll just run through these, and if you guys have questions on any of them, please put them in the Q&A. You can use your VA home loan more than once. You can have more than one VA loan at a time. Now, that doesn't mean you buy an investment property. It means you bought a house with a VA loan, and then you lived in it, and then you want to move and use the VA loan again and move into the next house. You can use a VA loan again. even without selling that first one. We talked about that a little bit earlier, but you don't have to sell or refinance that first one to use a VA home loan again. There's a little bit of math that goes into it if you're going to keep the first one, but you can absolutely do it. Service-connected disabilities reduce VA loan costs. So VA funding fee. If you have at least 10% VA disability, you will never pay a VA funding fee ever on a purchase, refi, IRRRL, none of it. Huge benefit there. All right. VA loans can close in as little as 14 days. So what we do, usually the appraisal is what takes the longest. So we build our pre-approvals. We collect all income documentation. We run credit. We calculate DTI. We do all of our calcs up front. And when that borrower goes under contract, that loan goes straight into underwriting. It's locked and loaded, all documentation ready to go. We've passed DU approval. Everything is done. Just send it straight into underwriting, and we order the appraisal right off the bat. And it's usually as soon as that appraisal comes back, we close because we do 95% of the work up front. So we can close VA loans very quickly. National Guard and reservists can qualify. So there are different requirements for what time period you served and whether you're in the Guard or in the reserve. But yeah, they can absolutely qualify. There is no size limit to a VA loan. This is one they changed a couple years ago. They removed the VA limit. So basically what the VA is saying is if the lender will approve you, then we will insure it, no matter how big the loan is. So the VA is not the lender. That's an important distinction. They're basically an insurance policy. You still have to get approved from a lender, but if you can get approved, then the VA will back it. So there's no size limit unless you have an active VA loan. If you're going to get another VA loan, then you are subject to the county loan limit. And to caveat that, you can go over that county loan limit. There's just a little bit more math that goes into it. There's a down payment that is required if you exceed your total entitlement. It ends up equaling 25 cents on the dollar for every dollar that you exceed that total entitlement. VA loan benefits never expire. VA loan you have for life, never goes away. And VA appraisals are not more difficult than conventional. Okay, so that's a sticking point for a lot of people. Basically, the VA program has changed a lot in the past couple of decades. It used to be different. It used to be pretty challenging, and that reputation kind of lingers. Nowadays, I mean, as long as realtors and buyers are aware of what the intent of the VA loan is and kind of what a VA appraiser is going to look for when they walk through these homes, then you'll be absolutely fine. It's designed to be a program that provides safe and sanitary and sound housing for service members. So they do look for things like peeling paint, broken windows, rotten wood, mold. That's the big ones. I mean, missing handrails, that one comes up sometimes. But as long as you kind of understand that and you're not trying to use the VA loan as like a fix and flip tool, I mean, you're going to be fine. And the vast majority of the time, the appraised value comes back right at purchase price, sometimes higher. I mean, sometimes it comes in lower, but then again, sometimes conventional comes in lower too. I've had more than one deal fall apart completely because a conventional appraiser went out and appraised it, 40, 50 grand below purchase price. So, at the end of the day, it's a pretty similar process to conventional, and I wouldn't allow that to be a reason why you go conventional over VA.
I should have mentioned this, but I don't think I did. But Trophy Point and Ray, we typically serve military affiliated folks. Actually, we typically lend to military affiliated guys and gals in the first place, and so there's a lot of overlap between what Ray and I do when it comes to the military community. Ray, I got to give you a shout out for literally putting bullets as the bullet points here on the slide. I think that's a fantastic.
You like that? There's a really common Idaho decal that people put on their trucks, and it's the Idaho gun like that, except it shoots a tree as a bullet. So I just changed it to a bullet.
I love it. That's so cool. Well, that being said, thanks so much, Ray. We appreciate you coming on and sharing a lot of your knowledge, sharing your experiences, and telling your story as well. And I know there are a lot of veterans actually on this call as well. So I hope they got something out of your remarks, because I think the VA loan is a powerful tool for building wealth, especially at the early stages of someone's kind of entrepreneurial journey. Like, you can use the VA in some unique ways that allow you to be entrepreneurial and still build wealth through your primary residence. So anyway, Ray, I appreciate you. Thanks so much for joining. Someone had asked a question about us and some other real estate lending funds. And, like I said, Trophy Point is focused mostly on single family and multifamily properties. We don't lend on land. We don't lend on commercial properties, strip malls, or anything like that, hotels or anything like that. We focus strictly on, what I would say essential housing or essential real estate, which is basically residential real estate, multifamily, which are known as apartments, and single family homes. And I don't think I know of any lenders or any fund managers out there that take the first hit up to their entire equity for any bad decisions they make. Usually they pass on the loss. They get to make the money in fees, and then they pass on the loss to the investors. And that's the complete opposite with Trophy Point. We take the first loss on anything. There's one question from an anonymous attendee. I'll just answer that live. If a deal won't work for a VA loan, does Trophy Point have a preferred long-term lender for refinancing? The short answer is yes, we do. We have numerous banks, numerous credit unions, even other non-bank lenders that do provide long-term financing, and it's all market dependent. So we have a vested interest in our borrowers getting out of our loans, and so we actually proactively work with longer-term refinance partners to refinance our loan out. So typically they're known as DSCR lenders. DSCR stands for debt service coverage ratio, which means that those lenders purely or mostly look at the income derived from the property in terms of the rent it provides, and that rent should be sufficient to cover the debt service or the monthly loan payment of the long-term loan. And that's typically how they do that. But we have lots of folks that we send loans to.
Can I chime in on that one too?
Yeah, go ahead. Yeah.
Yeah, so once the house is fixed up and ready to be placed into a permanent 30-year mortgage, if you have steady income and you can qualify for normal bank financing, even not necessarily a VA loan, but a 30-year conventional mortgage, a lot of times you'll get better terms than a DSCR. So I mean, you're going to hit a point if you start acquiring 7, 8, 9, 10, 15, 20 properties where lenders won't give you more conventional mortgages. But up until you hit that point, I mean, you'll get better terms on traditional bank financing, even if it is an investment loan, usually than DSCR. So I mean, it's worth the conversation to kind of look at both.
On the UMortgage side, do you do investment loans as well?
Yeah, 100%. I'd say
good.
90% of my business is VA, but 10% is conventional. And I'm familiar with investment products as well. So I just stick to VA as my niche, but I certainly can do conventional.
Oh, nice. Cool. Yeah. Thank you guys so much. And I'm going to stick around for a couple more minutes and we'll answer any additional questions you have, but have a great night.
Hey, Samir, thanks for having me, man. This was an honor to be here.
Likewise. Thank you so much too.